Today I want to jump on and do something I've never done before, and that's talk about my real estate portfolio and what it looks like in 2022. Now there's three main reasons that I want to share my portfolio and give you the breakdown of exactly what it consists of. Firstly is I think it shows my confidence in the local Cairns area. Now, if I'm this confident living, working, breathing the real estate in this area, maybe there's something to it, or maybe I'm completely wrong and about to lose it all. But I do think showing my portfolio does show my confidence in the local area, and maybe there's something to it. So maybe it is worth having a look into this area if you are looking at investing in Australia. The second big reason that I want to share my portfolio today is that I started this portfolio with my wife when I was 25 years old. We had a 2-year-old and a 6-month-old at the time that we purchased our first property, which was an absolute major renovation. And I really think, as much as it's a bit cliche to say it, if we were able to do it, I think anyone can. So with a bit of grit and determination, hopefully this video provides a bit of motivation that you can get out there and actually make this happen if you really want to make it work. The third big reason that I wanted to share my portfolio was for a long time there was this fallacy that there was no growth in Cairns, there was no growth in regional markets. And I think by showing sort of what we bought the properties for and what they're currently worth today really dispels this fallacy. So I want to jump into it and start on the first property me and my wife ever bought. I remember walking through this property. This was our first purchase as a couple, my second ever purchase and her first, and thinking, holy shit. It was very, very dilapidated. There was holes kicked in doors. It was absolutely falling apart. There was like an inch or two of cockroach shit and rat shit in the kitchen. It was really quite a sight to see. But my wife was determined and she convinced me that this was a great idea, and in we went, and essentially we bought this property for $245,000 back in 2016. At the time I was 25, and like I said earlier, we had a 2-year-old and a 6-month-old. One of the first things we did when we got into that property was we actually renovated one of the bedrooms to make it sort of a safe space. We lived in that property for a number of years, and we essentially had no kitchen for the first 6 to 8 months we were there. We had like a little camp kitchen set up, but we worked our ass off and we made that property work. In total, we spent about $40,000 on it. So we're in it for around $285,000. And today that property is worth close to $550,000 and rents for $530 a week. This property was really a cornerstone and a real foundation property for us on our investment journey, as it gave us so much capital and equity to play with down the track. Even back when we finished the renovations, we were in it for about $285. At that point in time, it was worth around $420, $430, and then has crept up in value over the last sort of 5 years. So that was our first property. Certainly one to be remembered, and one that we will look back on fondly. From there, we actually bought and sold 2 other properties between 2016 and 2019. So they're not on this list, but those 2 properties really helped us buy our family home that we're living in today. So those 2 properties, as much as we didn't hold on to them, were very much part of the story, I guess. Our second oldest property that we own is one in Manoora. It's a unit. This was a little bit of an emotional purchase. The numbers stacked up, but not as well as other deals. We bought it for $175. I think at the time it was renting for around $320 per week. It just was at a break even. It was worth buying, but nothing exceptional. But it has gone up in value quite considerably. It's gone up in value by $65,000 since we bought it. So we bought it in 2019 for $175. It's currently worth $240. The tenants in place are paying $380 per week on that one. So even though it's probably a least profitable deal out of the lot, but still quite a good outcome for something that hasn't performed as well as the others. Our next purchase from there was a full duplex in Earlville. So that was essentially 2 units on one block. We own the whole title. The 2 units are on one title. That one at the time, we paid pretty much a fair price for it. It was, I wouldn't say it was below market price. And it was a property that we bought simply for the rental returns. The rental returns were fantastic day one and have continued to climb and go up. and it really is a strong cash flow property, that duplex that we own. So we paid $365 for it. It's gone up almost by $200,000 since 2019 and is now worth around $550. And the property rents for $700 per week, which will soon go up again in rental price, as well as just due to the strong rental demand here in Cairns. So that property in Oval there was certainly one of our favourites in amongst the mix. Even though we didn't really buy it below market price, it's performed extremely well. Coming into 2020, and I don't know, it's a distant blur for some, but 2020 was COVID. Things were looking like the world was gonna flip upside down. The end was near. People were ringing bells in the street going, the end is near, the end is near.
The world will end next week! Spend your children's college fund! Thaw that turkey now!
And when we bought this property, it was pretty much around peak fear. There was news on the media and we questioned actually if we should be buying it. But we bought it for $105,000. It's a one-bedroom villa in a block of 4. And essentially in the 2 years that we've owned it, it's gone from $105,000 up to $170,000. So that's some really good growth. It has a really strong rental return on the purchase price. So it's currently renting for $300 per week. And the body corporates are very reasonable in that complex. So that's a great little asset, that one. And a property now, looking back on it, that we're actually glad that we went through with that purchase, because like I say, at the time it really was peak fear. There was a lot of concern around COVID and what might come from that. Later on in 2020, we actually sold 2 properties and that helped fund our family home. Now, the family home was purely an emotional purchase. We weren't trying to get the best possible price for it. If anything, we probably overpaid at the time. We actually paid a suburb record for Menora to get into that property. We wanted it, we loved it. We were purely being emotional, so a bit of a different contrast to the other properties. There was just nothing but pure emotion behind that purchase. But it's a home that we still love, so we bought that in 2020, and the sale of 2 properties helped purchase that one. Fast forward to 2021, so just last year, towards the end of last year, we had the opportunity to secure a really run-down property in Menora. So we picked that up for $240,000, and it was a complete disaster. There was literally holes in the walls everywhere, no functioning kitchen, no functioning bathroom, overgrown gardens. It was horrendous. We actually didn't feel like we had the equity there to buy that on our own and undergo the renovations, plus the time and effort that were going to be involved in doing those renovations to a standard that we were happy with. So we brought in a good friend of ours and we went 50-50 in that project. The interesting thing is, during that process of financing that purchase, we had our property in Irville, the duplex, valued, and that valuation come back a lot higher than we expected. Thanks to that valuation coming back higher than expected, we had equity to play with. So we kept our friend in that project on Till Street with us, that Menunda renovation. But we actually had another opportunity present itself during the settlement of the Menunda property, and that was to go halves in a block of 4 units. So the whole block was 4 strata titled units. We had an opportunity to buy 2 of the 4, and a good friend of ours bought the other 2. So together we control the full complex there, and there's no body corporate fees. This property in White Rock was an absolute cash flow dream. Essentially, we picked it up for $350,000, and our share of the property, so that was our share of the 2 units with $350,000, and our share rents for $720 per week, which is a magnificent return, especially when you can look at the outgoings on that one. They're very minimal for that $720 week return. That property now has gone from $350 up to about $450. It's gained about $100,000 in less than a year. And as for the Till Street property, going back to that one, the Menunda renovation that we did with our friend, it was definitely our most testing project yet. There was about a 4-month renovation, a whole lot of sweat, blood and tears, a couple of meltdowns. But essentially we ended up in that one for $300,000, and today it's worth around 475. So there was 175 grand of uplift in that, and it's renting for 550 per week, so a really strong cash flow. So that's a breakdown of our portfolio. You can see there's no real location that we're focused on, and there's no real one type of property. We've got units, we've got houses, we've got duplexes. We are across the board. And I think this really comes back to one of my closing points, and that is a deal's a deal. So if you know your local market, it doesn't matter, I feel, if you're looking at units, duplexes, houses, it's identifying what a good deal looks like across those property types. The more open you can be to the marketplace, the more likely you are to find that absolute cracking deal more regularly. Where if you're just focusing on one suburb or one property type, you're limiting yourself from 80 or 90,000 houses down to maybe 3,000 or 4,000 houses. So the chance of finding that cracking deal does become smaller and smaller. So I just want to summarize what our portfolio looks like. Essentially, we've got 8 rentals, so 8 different leases in place, plus our primary place of residency. In total, it's almost $3 million worth of property. And focusing on just the rental, the investment properties, we've got around $2.2 million worth of properties, and we've got about 1.4 mil of debt on these properties. So if you're from Sydney or Melbourne, you might be going, man, that is the price of just one property. And here we are with 8 rentals. So depending on your markets, you may want to look elsewhere to see what deals are around. Essentially, this 2.2 million worth of investments returns 151,000 of gross rent, and that's a portfolio that we've built in 6 years, so quite a short time frame. We really did work really hard in the beginning there and during a couple of those renovations, but now we really are seeing the fruits of our labour, so to speak. Now, one of the big concerns when I tell people about this portfolio is like, oh, interest rates are going to the moon. And the reality is this portfolio currently sits at around 8.2% net return. So after council rates, after insurance, excluding interest, we're sitting at about an 8.2% return. So that means that interest rates would have to go well up over 8% before we're actually out of pocket on these properties. And the reality is I can't see interest rates going back to 8%. When you look at the debt to income ratios of Sydney and Melbourne, essentially they would kill the economy by putting interest rates back to 8%, and I can't foresee that happening. So I think this is a really safe bet, this portfolio. So to close off with a couple of real takeaways here, I think when you're looking at investing, you'll either find a way or find an excuse not to. If you really delve down and look at the numbers and get confidence in the market you're looking to invest in, I think very quickly you'll find that way. Otherwise, if you're just looking at it on the surface, you'll probably find an excuse not to buy into that particular area. When we built this property, we were really looking at the downside risks. At the time, the rental yields were really strong. We could basically buy these properties and have the tenants pay them off for us over the life of the loan, and eventually we would own the asset outright. So even if we didn't see capital growth, even if we saw a decline in the purchase prices, we'd still have assets getting paid off for us that would then own outright into the future. So the downside risk I thought was really minimal when looking at buying these properties. And the last thing, like I mentioned a bit earlier, was I really don't think the property type matters. I think it's all about finding that one that the deal really stacks up. Be it a below market property, be it a high rental yield property. Keep your mind open to different property types, as you're more likely to find that really cracking deal that stacks up well that you can leverage into the next deal and the deal after that. So there you have it. That's my property portfolio in 2022. We've built that over 6 years through hard work, through determination, but I really feel it is replicatable. You might not be able to buy a house in the market for 240 today, but there's opportunities, there's units around for 240. You might have to go to Gordonvale or a little bit further out of Cairns to find similar price points, but those opportunities still exist. So get out there. If you are looking to build a portfolio, start doing your research, because there's such great opportunities around. It would be a shame to look back in 10 years and go, we never took action. If you have enjoyed this video, make sure you subscribe. We put out a heap of content on this channel, and I love bringing you new videos. Have a fantastic day, and I'll talk to you soon.